Welcome to Morphic Labs, and today we are going to be discussing run bars and Parkinson volatility aggression. But this one's gonna be a quick one. I got a class to get to. Now, before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. And I have a free market microstructure and trading systems course, plus an advanced market aggregation course. The link's in the description if you want to get it for free. And let's get into it. Now, what is a run bar? Here's the formula. Run bars clock when a consecutive sequence of same direction trades exceeds a threshold, capturing sustained directional pressure. Formula: 3 consecutive ticks in the same direction defined as run count equals the number of consecutive b sub t equal 1 or b sub t equals -1. Bar closes when run count is greater than or equal to some threshold. When to use momentum strategy development, detecting sustained buying selling pressure, trend initiation, identification, breakout confirmation. Advantages: captures sustained directional moves, filters out choppy directionless markets, useful for momentum strategies, adapts to market pace. Disadvantages: run threshold selection is subjective, may miss reversal signals, can create long bars in trending markets, limited adoption in standard platforms. Now let's get into the code. I'm gonna be using my Dow Jones Industrial 1 minute code, and I've already ran this 100 indexes and a threshold of 3. And essentially, as you can see, we have a run bar with threshold of 3, and whenever you see a bar closer where these vertical lines are, that's where essentially our condition is met, right? That's where the bar close run is greater than or equal to some threshold. Now, let's run this for a higher I or a higher index, right? 1,000 indices, and as you can see, we have more structure, more interesting geometry that can be taken advantage of. Now, let's get into Parkinson volatility aggregation. The Parkinson estimator used the Parkinson volatility aggregation. The Parkinson estimator uses the high-low range to estimate volatility, providing a robust measure that is less affected by opening and closing effects. Parkinson volatility bars. Based on the Parkinson 1980 estimator, which uses the logarithmic high-low range formula. Parkinson estimator defined as sigma squared sub p equals 1 over 4n times the natural log of 2 times the sum of the natural log of h sub I over l sub I squared up until I equals 1 to n. The bar close condition is defined as sigma squared sub p is greater than or equal to sigma squared sub target. When to use: when only high-low data is available. Intraday volatility monitoring. Robust volatility estimation. Historical analysis with limited data. Complementing other volatility measures. Advantages: does not require open closing prices. More efficient than close to close. Robust to overnight gaps. Simple to compute. Work with historical data. Disadvantages: assumes continuous trading. Underestimates volatility with jumps, ignores opening closing information, sensitive to extreme high-low values, less accurate than the garment class. Now let's get into the code. I'm going to be using my Dow Jones Industrial data. I already ran this. It has a target of 0.0000001, right? And if you've ever watched my previous videos on volatility, you know volatility needs targets this small in order to capture the dynamics of the market. Now, with this threshold, with only 400 entries, of course, as you can see, where the close happened, right, the vertical lines and the red and green ones, it tells you that our condition sigma sub p squared is greater than or equal than sigma squared sub target, right? Essentially, the red bars and the red shapes represent what side the volatility or the market was on, right? And the bar close essentially represents where the condition was met, as I said before. But what's interesting is not where the bar gets closed. What's interesting is where it doesn't get closed, right? Because when you look at where it doesn't get closed, most of these periods looks like the market is either moving sideways or is indecisive. It's in between up and down, right? Now we're going to push this to 1,000 entries, and I'm going to essentially make the estimator true, because when you go back and look at the formal reference, the Parkinson estimator sigma sub p squared can also be analyzed while watching the closes, right? So here it is. As you can see, the green vertical lines represent a bar close, right? The blue line represents sigma squared sub p, right? And the red line represents sigma squared sub target. So look at how many times the target was hit, right? And it makes sense there are so many bar closes, right? Because when you look at the estimator's progress, pay attention to the periods where there were no closes, right? Pay attention to those periods, because when you look at sigma squared sub p, essentially as our high and low index up until n, we have this beautiful geometry that essentially represents that the market might be hitting this target more than we think, right? But as usual, the most interesting periods are where the target is not hit. But that's about it for today. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course, plus a free advanced market aggregation course that links in the description. You can get these two for free if you sign up to be a member. And do me a favor, if you're interested in keeping up with more content like this, hit the subscribe button, and I am out. Bye.